Our view today is that the earnings are not normal, they are understated, which means actually the earnings should have been slightly higher. So, which would have brought the PE level lower. And two major index constituents are banks and IT. Banks are about 30-35% of the index, and IT is around 15% of the index. So, hello everyone. I am back with the OmniScience videos. And the first question, and market has been doing very well for more than a year now. Probably, if you are okay with the dips and ups and downs, then for last 3 years, it's been doing really well. So naturally, the question in most people's mind is, and which is always there, is it the correct time to invest? Okay, so before jumping into that, again, let me go through the disclaimer. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. So is it the correct time to invest? Okay, and there are multiple ways to look at it, but the most important way, we are scientific investors, we look at valuations versus what is the price in the market. So when you are trying to judge is it the right time to invest, you have to ask for each stock you are buying, or for each portfolio you are investing in, or for the overall market levels, right? When I say overall market levels, the primary indices like the large cap index, either Nifty 50 or Sensex, or you are talking about the mid cap index or the small cap index. So you can ask this question at the index level. So the first thing I would look at is the index valuations, right? And the natural thing, when you say valuation, people think of the PE ratio. There are other things you can look at, right? More sophisticated things, but right now the normal person understands PE ratio as the valuation parameter. So look at the PE. Is the PE at peak? If the PE ratio looks like it is at peak, then naturally you should be worried about uh, is it the correct time to invest. Maybe you are at the peak of the bubble. You will never know, right, whether you are at the peak of the bubble. It's not written anywhere that now we are at the peak, right? So you look at the valuation levels. For example, today it is around 23 to 24 is the PE level, right? So even when you're looking at the PE level, the average long term average has been for India around 19 or 20 for Nifty 50, right? So now we are at 23, 24. It looks slightly higher. But if you actually talk about the peaks, it has gone as high as 27, 28, or even 29. Right? So we are nowhere close to that, number one. Number two, are the earnings normal? Our view today is that the earnings are not normal, they are understated, which means actually the earnings should have been slightly higher. So, which would have brought the PE level lower. And two major index constituents are banks and IT. Banks are about 30-35% of the index, and IT is around 15% of the index. So if you put this together, they are nearly 50% of the total markets. In our view, both of these sectors are significantly understated. IT companies, because this year was a below normal year, earnings were lower for many companies. Next year earnings are expected to be much higher. Number one. Number two, banks. Again, banks are still recovering from their original, so they are getting into the cleanup. They've already cleaned up their balance sheets, and the ROEs have started improving. For private sector banks, ROEs are at 15-16%. At the peak of the economic boom cycle, they go as high as 25% or so. For public sector banks, they are at below 10 for a lot of them. Some of them are 13, 14, but a lot of them are below 10. And at the peak, they probably go around 17, 18%. Okay. So the both of these sectors, the earnings are significantly understated. If I adjust even slightly, it will bring the Nifty level below 20 or around 20. So our view is that it's not overvalued. If it's not overvalued, then yes, if you have surplus capital to deploy, then it makes sense to enter. Okay. Now this is the, as it is, way of judging the market. Second question which keeps coming is, what is the outlook for 2024, right? So the outlook for the year 2024, in our opinion, most of the things look positive. The most important factor is the Fed action, right? So US Federal Reserve Bank, which is similar to our Reserve Bank of India, right? And they are expected to cut rates. The Fed dot plot, or what is kind of like a consensus, it's not a consensus but the average of all the views of the members, it is that they're going to have three rate cuts, 25 basis point, 0.25% during the year. Okay. Our view is that it's likely to be even more, and it's likely to be earlier in the cycle. Okay. So we think around there could be as high as 6 rate cuts, right? And it could be some rate cuts of 50 basis points as well. So this is our view on rate cuts. So if aggressive cuts happen, significant cuts happen, they're typically an upside towards the market. When Fed does it, RBI is more or less likely to follow, okay, on the same direction. The quantum could be different and the pace of RBI could be different. But again, and secondly, there is election year both in US and India, which is also favoring a more growth oriented bias. Okay, so from all those point of view, third, FI money also we expect to come significantly into India. First, because of the rate cut itself. The second, also because of people are trying to exit China from the emerging markets and enter into India. So when that substitution happens, and China is 30% plus of the emerging market indices, while India used to be 10%, now India is 15. And if people are going to be ex-China and into emerging markets, then India becomes a very large proportion of that remaining. So we are quite positive on the markets. Third question people ask is, should I do SIP or lump sum? Now you have to do SIP when you have uncertainty in mind. Okay. While when the outlook is quite positive, lump sum is better because higher levels are expected in future with higher probability. Nobody can say that there won't be a dip or whatever. Uh, but the dips are less likely and likely to be shallower dips, if at all. So markets are always markets, they will be choppy, but I would do a significant lump sum personally. It all depends on your risk situation. You have to take advice from a investment advisor. This cannot be advice on video, right? But very broadly, if I have 100 rupees to invest, I would do a significant portion as lump sum, and I would follow it up with a SIP all the time, right? So I hope it answers most of the questions which are coming into people's mind. And this is based on the frequently asked questions we are getting from potential investors and existing investors. So hope this answers you, and thank you.